All right, so the question is, are we currently in a bull or bear market? Now, I am recording this in March 2025, but it doesn't really matter when you're listening to this if it's later. One of the things about, well, crypto in particular, but it also, you could say the same thing for stocks as well, and they're pretty well correlated. But one of the things is you never really quite know where you are, whether you're in a bull or a bear market. It's very difficult to tell. And you only really know in hindsight, looking back. You can't look back to just yesterday or the day before or anything like that for confirmation. It's only like pretty much 3 to 6 months later that you can look back and you can say, well, at that time when I was wondering, were we in a bull or a bear? Now I know for sure where we were, because you had the context of the future and you also have the context still of the past, and you need all of that to come to a decision about whether you're in a bull or a bear. You need a bit of future context, and you still need, of course, the previous context. But at any given moment, when you're saying today, where are we? Are we in a bull or are we in a bear right now? It's very, very difficult to tell. It's constantly playing tricks on you, the market. Every time you think, right, I think we're in a bull, I think we're going to continue in a bull, therefore I'm bullish, therefore I'm holding or even buying. And how many times does that happen? And then the reverse happens, the price goes against you, right? And then when the price goes against you, you still don't know for sure. Are we in a bull and just temporarily retracing back? Or is this the beginning of a bear market? You just never know. Nobody ever knows. And that's the nature of the market. If anybody knew for sure, it would already be reflected in today's price. So let's say today the price is 100, right? And you think we're in a bull market, and everybody else does. Everybody else thinks that in a week it's going to go to 110. Well, if everyone knew that for sure, with a high level of confidence, the price would already be 110. You see what I mean? So today's price is not only a reflection of what people are thinking today, more accurately, it's a reflection of where in aggregate, combined, everybody thinks the price will be in a week or 2 weeks or a month or whatever. It's where they think it's going to go, right? And actually, if you look at something like commodities, it's not only where they think it's going to go, but it also includes things like, the price of delivery. But in general, for any financial instrument, today is a reflection of expectation of tomorrow. When I say tomorrow, I don't literally mean only one day forward. I mean longer even. But it is an aggregate of all the opinions in the market of where we're going to go. So that's why it's always a little bit childish when people say, well, it's definitely going to go up. Well, if it was definitely going to go up, then the price would be higher than it is today. There's no guaranteed about any of these things. Nobody knows, right? Nobody knows, and the price reflects that expectation. I know what you're thinking, right? You're probably thinking, well, in the long run, stocks always go up, and yeah, you do have a point there, but you've got to look at all the stocks that are in the current index today. Like, not every stock is destined to go up. Companies, especially now more than ever, a lot of companies, they're not even making any revenue. The idea is they're going out there, especially in the early days, to just get market share, and people bank on them later on making profits. So a lot of it is hype, speculation. If you look at the current index today, you can't guarantee. Let's say an index contains 100 stocks in it. You can't guarantee those 100 companies are going to be around in 10 years' time. If you take the value of all those companies today and compare them in 10 years' time, there's no guarantees that they're going to be worth more today in 10 years than they are today. In fact, there's a good chance that they'll be worth less. But of course, the index in 10 years won't be composed of those same 100 companies. So if an index is always kind of going up, and it doesn't always, right? Indexes don't always go up. There's been some pretty heady years recently. A lot of people say everything is overpriced. But even if an index you think is guaranteed to go up, that index won't contain the same basket of companies in 10 years that it does today. So it's not, if the index has gone up, it's not the same as saying that those companies have gone up. They haven't. The companies are getting added and removed from indexes all the time. It's very, very different. Now, you could say that a fund will go up, a fund of that is based on an index that is based on companies, and that's a different matter. And yeah, I would say in the long term that a fund that is based on an index should, in theory, go up if you're going long for like 40 years or whatever. But it's also not guaranteed. There can be life-changing crashes where you might have been saving for your pension for 40 years and thinking, I did the right thing way back then because indexes never go down, and then bang, 2 years before retirement it all crashes, and for whatever reason you didn't change strategy as you neared retirement. You didn't swap out most of your stock market exposure for cash and bonds, and you're massively down. And it's happened, right? People have thought that they had a guaranteed pension and had done really well, and in the end they really hadn't done very well at all. So that's just a discussion basically on bull and bear markets. It's always tricky. You never quite know whether you're looking in the short term or the medium term or the long term. You never quite know if you're going to go up or down. It's very, very difficult to tell, and that's why so many people outsource even their long-term stock picks, etc. They leave that to the so-called professionals, to fund managers, who of course even they're not perfect. Even they can lose. And of course, one of the big problems is they take a hefty fee. And so when people take a hefty fee, that eats into your profits. It affects your returns. It's not always a guaranteed great outcome. And this is also why a lot of people don't trust fund managers. They think their fees are too big. They think maybe they make the wrong picks, and they'd rather pick themselves. So there's a lot of disagreement about that. Is it better to pick yourself? Is it better to trust yourself, or can you not trust yourself? Are you too emotional and can't invest yourself? Anyway, that's a whole other discussion. But going back to the original question, are we currently in a bull or a bear? One can never really tell. You've just got to try and manage risk, and if you believe in investment, try and hold things that may not make you as big a profit, but should long term even out, be a good long term hold, rather than trying to swing trade and that type of thing, the kind of thing that hedge funds would do. It's up to you. A lot of it depends on your risk appetite as well. So I hope you found this discussion interesting to listen to. Let me know what you think. Give it a like, and I'll see you again soon. Take care. Bye bye.